Just signed on July 4th of 2025, President Trump's one big, beautiful tax bill brings many tax changes. Who wins? Who pays? Let's break down exactly what business owners and individuals need to know. What's up, Ledgerly viewers? Mike, CPA, back at it again, bringing you the latest and greatest, just like this video today. So let's dive right into it. President Trump signed the one big, beautiful bill on this past 4th of July, Independence Day of 2025. A massive tax and spending law that locks in tax cuts, new deductions, changes to the SALT limitations, estate planning, business taxes, and individual taxes. So it directly impacts you, the American taxpayer. But is it for the good or for the bad? Let's dive in. All right, so for you individual taxpayers out there, your standard deduction is going up, not down. That's a win. So for single individuals, $15,750, married individuals, $31,500, or what's also not here is head of household. Head of household is going to $23,625. What does this mean? This means that more of your income is protected from paying tax at the federal level and the state level if you live in a state that has income tax, which is most of them. Okay, moving on. Temporary SALT limitation cap is raised. What's the SALT limitation? State and local taxes. So what falls into this bucket? It's your real estate taxes and your state income taxes. Now, why is this such an important matter? Well, for those who itemize your deductions, if you want to learn a little bit more on itemizing, go over to my partner Andrew's video on itemizing on our YouTube channel. But if you itemize your deductions, your taxes, those SALT taxes were capped at $10,000. Now there's a temporary cap to increase that to $40,000. So for you individuals who live in an area where your real estate taxes are really high, your mill rate is really high, or if you're paying a lot in state income taxes, or if you're a business owner and you have a pass-through entity tax credit that comes onto your personal individual tax return, that's no longer capped at $10,000. Now it's capped at 40. But why is it temporary? It's temporary because all these high up government officials who don't live in a state that has income taxes, it's not going to benefit them. But for you individuals who do itemize and pay a hefty chunk of change on real estate taxes and or state income taxes, well, you might find yourself a bigger deduction, which leads to more money in your pocket. All right, moving on. New tax breaks on tips and overtime. For tips, workers can deduct up to $25,000 in reported tip income from their federal income. For you overtime workers who are reeling and dealing and grinding it out, you're also entitled to a deduction of up to $12,500 if you're single or $25,000 if you're married. However, there are income limits here. Deductions do phase out for those single filers earning over $150,000 and joint filers earning over $300,000. And as of right now, the duration of this new tax break for tips and overtime is going from 2025 to 2028. So expiring in 2028 as of right now. However, very important note, these are only being applied to your federal income tax, meaning that your payroll taxes, your FICA, your Social Security, Medicare, those two taxes, you're still going to pay those taxes. This is only for your federal income tax, not the payroll taxes. Okay, and the number 4, last but not least on our list, for individuals, you're going to see a small increase in your child tax credits. All you parents out there with kids, you're going to see this increase from $2,000 to $2,200 per child. And also the refundable portion of the child tax credit has also been increased to $1,700 from $1,400. So it pays off to be young, but it also pays off to be older, but young at heart, of course. And that's for all of you over the age of 65. You're also going to be seeing an additional deduction of $6,000. And that's on top of your standard deduction. Now, again, for these, income limits do apply and phase outs do begin at certain income levels. All you business owners out there, listen up, you in the back, let's rock. Do you like deductions? I like deductions. The QBI deduction, the qualified business income deduction, is back on the table and is permanent. Let's go. Now, what is the QBI deduction? It's a 20% deduction of essentially your business net income, your taxable profit. So if you made $100,000 in your business, you're going to get a 20% deduction, which is $20,000. So you're going to pay tax on $80,000 instead of the $100,000. So this is back. It's permanent. And who does it apply to? It applies to you single member LLCs, you S corporation owners, your sole proprietorships, your partnerships. But like individuals, This flows down to you. So there are income limitations, and the specified service business limitations also apply here as well. So the rule of thumb here is if you're a small business owner, keep in mind that when you look at your balance sheet and profit and loss on a monthly basis, hopefully they're up to date and they're clean and accurate. When you're looking at your net income number, you got to ask yourself, do I qualify for the qualified business income deduction of 20%? If the answer is yes, then make sure that you're applying that to your net income. Cool. Okay. Another one I'm fired up about. Bonus depreciation, 100% back on the table. Let's frickin' go. We can smell this one from a mile away. We knew this was coming back. Trump put his foot down in the ground. He was like, I'm supporting my small businesses and business owners. Let's freaking go. This is huge. This is going to encourage all of you small business owners to go out and purchase property, plant, and equipment for your business to help you generate revenue and take your business to the next level. Okay, I'm fired up. Let me take a step back. Let's go through why this is so important. So bonus depreciation back permanently, 100%. For the past couple of years, it's been a rolling down snowball of 100% to 80% to 60% to 40%. And eventually getting phased out. Now it went right back up the mountain. It's back at 100%. So now businesses, you can deduct 100% of qualifying machinery, equipment, computers, anything that is a revenue generating asset for you and your business, backdated to January 19th of 2025. So anything bought January 19th of 2025 and going forward, bonus depreciation, baby. This is huge because it's going to accelerate your tax deductions in the current year, and you're still going to have those assets to help you produce and generate revenue year over year. So huge bonus depreciation. Let's go. Two more quick hitters. Domestic research and development costs can now be expensed in the year, incurred or paid if you're cash basis, rather than amortized. But make sure you're keeping this in your back pocket. Research and development tax credits. Make sure you're doing your due diligence and applying if you qualify for those, if you're developing new software. Okay, and then lastly, the big beautiful tax bill has permanently reinstated the EBITDA, also known as the earnings before interest, taxes, depreciation, and amortization limitation based on business net interest deductions. Cool. So for you business owners, the two heavy hitters here are the QBI and the bonus depreciation. All right, next, the Trump accounts. I love this one. This is really putting the cherry on top for all of you individuals out there with kids to start building that generational wealth for your kids' future. So essentially, it's a savings account for your newborns. So essentially how this timeline is going to work is every child that is born in the United States will have a one-time deposit by the federal government of $1,000. And every year, parents or legal guardians can contribute up to $5,000 per child into this account. And then once the child turns 18, tax-free withdrawals can be made for education, housing, retirement, healthcare expenses, first-time home buyer, all tax-free. Sound familiar? Sounds a lot like a Roth IRA to me. This is such a cool and special incentive because I'm a tax advisor. I want to teach you how to not pay taxes. But the federal government is like putting the floaties on the baby and throwing them in the pool. They're not going to sink, but they're going to float. And it's incentivizing the parents to get in there and help them and create that generational wealth and create that financial literacy for your children. So I freaking love this. And there's going to be a lot more that goes into this Trump account if you're a business owner when you're paying your kids. If you want to learn more on that, head over again to our YouTube page on Paying the Kids. Okay, so who does the bill benefit? As we went over, for you business owners, it's going to benefit you. The QBI deduction, the bonus depreciation, huge wins. How about you high-income individuals in those high-income states? Gonna benefit you too. I don't know about you, but I like to deduct more tax than less tax. So that $40,000 SALT limitation cap increasing, boom, huge win for you as well. And also, we gotta care about our young ones, right? The Trump accounts are freaking awesome, man. Like if we think about it, even if you contribute $1,000 a year for your children, that's $18,000. That's probably gonna compound between 6 to 10% if it's in the stock market. And that is going to give your children that financial literacy that this world needs. Okay, but who does it not benefit? For those of you on Medicaid and those of you on SNAP, which are essentially the food stamps, there's some significant budget cuts here. The federal Medicaid is going to be cut by 15% over the next 10 years. And the same goes for the food stamps at around 20% over the next 10 years. And also, all of you out there that love your green energy credits, those are being phased out as well. The clean electric EV vehicle credit being phased out after this coming September 30th. Alternative fuel credit being phased out next June of 2026. Home energy improvements being phased out after December 31st, 2025. Commercial energy efficiency credit being phased out next June 2026. New energy efficient home credit ending again next June 2026. So essentially the green energy investor credits, they're essentially gone. You can cue the Price is Right. Dun, 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 wah, wah. So for all of you relying on those energy efficiency credits, unfortunately, you're kind of out of luck. All right, let's bring it on home, as Robert Plant would sing. Let's be proactive. We're basically halfway through 2025. There's tons of time to assess and plan for the rest of this tax year and going forward. See if you're eligible for some of these deductions that we went over. Maybe you were taking the standard deduction last year, but you might be itemizing this year because of the SALT limitation increasing. Business owners, keep in mind those two powerhouse things that are still on the table, the QBI and the bonus depreciation. Those are back. For all you parents out there, you new parents out there, thinking of having kids, keep in mind the Trump accounts. And last but not least, review your estate plan with an attorney, your CPA. Make sure you are being proactive because in 4 years, we don't know if the tax bill is going to change again. So this all being said, make sure you're being proactive. Talk to your tax advisor before it gets too late, before the sun sets at the end of 25 and it's already 2026. And some of these new items in the bill that could have benefited you in 2025, it might be too late if we wait. So we hope this was helpful. This is just scratching the surface on Trump's new big, beautiful bill. Please comment below on some other videos and topics you'd like to see within the bill or outside of the bill. And make sure you subscribe for the latest and greatest updates. As the bill says, stay beautiful, my friends.